the idea that financial independence is all about some number on your account statement, or even worse, that you don't qualify because of where you started out. That's just not true. It's not about some well-kept secret of the wealthy. It's about finding the right information and knowing how to apply it. On the Get Ready for the Future show, we're answering your questions so you can start making real financial change today. The journey to true financial independence begins right here, and it starts with you.
Time to settle in for the next 30-plus minutes as we help people discover, protect, and share true financial independence. Welcome in, whether you're watching online or listening on radio or on podcast. This is the Get Ready for the Future show. And I am Scott Inman, along with me, Tim Key. We are partners in the Little Rock office, and we're partners on the radio/internet today. Welcome aboard. It's been a few, I was going to say weeks, maybe even months since you've been on the show with us.
It's been a month or two, but it's good to be back on.
Yeah, well, we're glad you're here, and we've got some good questions to talk over today. Before we get into that, we want to tell you about a couple of opportunities to come see us as we branch out into the workshop realm, as we've done for a decade or more here at GenWealth. And we've had some in the recent past, but we've got a couple we want to tell you about, and some opportunities if you're nearby and want to come to them. And as always, they're free. Coming up on May 7th, as we enter the month of May, that's less than a week away now as we record the live stream here on Wednesday, May 1st. So next Tuesday, May 7th at 6:30 at the Chenal Event Venue in Little Rock, we are presenting 3 keys to retirement income planning. And we want you to join us for that. Again, it's free. We'll have dinner there as well. And there are some opportunities if you're getting into that, what we call retirement red zone. And we're going to talk about that a little bit today as well, which we define as about 5 to 10 years away from possibly leaving work and reaching financial independence and having your assets produce your income. You're going to want to know these 3 keys to retirement income planning. To join us, just go to getreadyforthefuture.com/academy. Sign up. Let us know you're coming. And then there is also an opportunity coming up to join us in El Dorado. We're going to be talking about Social Security there at the El Dorado Conference Center on May 14th at 6:30. That one is called How to Maximize Your Social Security. When you think about retirement income planning, we talk about it all the time on this show, how important Social Security is and making the most out of your benefit, making the right decisions when it comes to claiming Social Security can make a lot of difference in the success of your retirement. So you can join us at that workshop as well, coming up on May 14th at 6:30 at the El Dorado Conference Center. Just visit getreadyforthefuture.com/academy. Same website address there to join us for that. And if you have questions for us as we dive into 4 questions here today, call or text them to us at 501-381-5228. You can leave a voicemail or you can send us a text to that number. You can also send us an email, show@getreadyforthefuture.com. As always on the Get Ready for the Future show, we're here to answer any question, anything that's on your mind about finances, retirement, investments. As we sit here today entering the 5th month of the year. It's hard to believe we're a third of the way through 2024. Got some great stuff on the Fastest 4 this week about where we are in the markets as you start to hear probably out there amidst the noise that is always prevalent. You'll probably hear this term called sell in May and go away. What is that all about? We're talking about that this week on the Fastest 4 Minutes in Finance. If you listen on the radio version of the Get Ready for the Future show, that's coming up. So just hang in there. It'll be towards the end of the hour. But if you are listening on podcast or watching on live stream, want to suggest that you check us out on podcast or sign up and get it delivered directly to your email inbox. You can text the word FAST to 501-381-5228. 501-381-5228. Just text the word FAST, and we'll get your email, and you can get that delivered to your email inbox on Friday morning. We're not going to blow your email inbox up week long. It's just that one 4-minute or less video about what's going on in the markets. All right, enough about that. We've promoted enough.
There's a lot of promotion there, but I do highly recommend that Fastest 4 on Friday mornings at 7 o'clock. That's one of the first things that will hit my email box that day, and that's one thing I catch every week on Friday morning.
All right, let's dive in. Rachel via text asks, I'm 62 and own a small business. My business has always been my retirement plan, so I don't have a whole lot by way of savings. As I'm getting older, thinking about selling my business is scary, and I'm not sure if that's the right move. Will it be enough on its own? What are my other options this late in the game? Rachel, I want to encourage you, even at 62, it is not too late. And certainly there are some things we need to work through on that. I do think of a client that Tim and I share together that he was about in this same situation when he came to us a few years ago. He has a small business. He had not really accumulated much savings outside of that. He poured everything, his heart and soul and his money, into that small business, in growing that small business, and it's successful. And at some point in the future, that will be a major part of his retirement income plan. But he hasn't counted on that solely. He came to us. He had a simple IRA as part of his employer-offered plan to his other employees, and we're going to talk about that as an option. But he was contributing to that, but he was ready to ramp that up and get serious about it. And he's made some major strides, Tim, just in the last couple of years with us. So I want to encourage Rachel, first of all, it is not too late.
Absolutely. And for small business owners, and Rachel, just thank you for being a small business owner. That's really one of the great things of America, and being able to have that opportunity. But like Scott mentioned, a lot of small business owners, they put everything, their heart and soul, into that company, and that is their retirement in most cases. But again, we need to find out, if you haven't, what's that company worth? What's the valuation on that business? Because that is going to be a critical piece of your overall retirement plan. And there's a lot of different things that go along with that too. And we've had some small business owners in here that they are the business. And so it's really hard to sell something even though you built something up, because you're an integral part of that. And if you're not part of that ongoing, then it may be very difficult to get a good valuation on that business. But again, we need to be able to have a good valuation on what that business is going to look like. And again, like we've talked so many times, we're going to have to turn that valuation, that sale of that business, into retirement income throughout the rest of your life. And so that's really our main goal here, is to get an outcome on this. So there's lots of different questions and lots of different opportunities for someone like this.
Yeah, just to echo what Tim said, I think the first thing you have to do, Rachel, is get a valuation on that business. You have to know what it's worth to be able to plan for your retirement. And then I think, who are your potential buyers? If you're going to sell to strangers, or are you going to sell to family? Is there some sort of succession plan in place there? Do you have a business that would allow you to receive some sort of income after leaving the business? Those are all variables that really need to be determined so that you can start to build a retirement income plan. But let's ask also your timeline. How long do you want to work before transitioning out? You're 62, so you're telling us, I think, as you get closer to, or as you send this question, I think when you tell us that the thought of selling your business is scary, you are starting to think about it pretty seriously. We need to define what exactly is your timeline to build that plan. Is it 3 years? Is it 7 years? Because really, if you have, I'd say 5 years or more, just like our client that we already talked about, there are some other options that you can be building retirement savings external to the value of your business and external to selling your business. So let's talk about those. There are some things you can set up if you haven't already set up. Tim, let's start with the simple IRA. That's our client that we've kind of used it as an example. He already had that in place, and that's common. We have it here at GenWealth. And if Rachel has several employees, that's probably what she would want to do if she hasn't already done.
Yeah, a simple IRA is very cost-effective for a business to set up, very low cost, really, compared to setting up a 401k, because there's a lot of other things that go into a 401k. So usually small businesses avoid the 401k, though we have seen some. But the simple IRA, real easy to get set up. And the thing is that you're going to probably contribute up to 3% or match 3% of someone's salary. So each employee will have the option to be a part of the simple IRA. They will have the ability to make contributions from each of their paychecks. And there are certain limits on that, and those limits will change every year. And currently, I think Scott has written those down, and it's hard to remember them every year because they do change. They do go up just a little bit. And so you also have the catch-up ability once you turn 50 to actually contribute a little bit more to that. And so the simple IRA, that's what we have here at our office at GenWealth. So all the employees can participate in that, and they do have the option to not. But obviously, the owner of the one that we have that we were discussing, he really wants to make those benefits attractive to try to be able to get additional employees, high-level employees, and to be able to give a retirement package to them, which is very important in his mind, and we're thankful for that, because obviously if you can start someone getting contributions early, then they can actually build up a retirement balance to eventually turn into that retirement income.
Yeah, so on the employee side, you can put $16,000 in 2024, and if you're 50 and older like you are, Rachel, you could have a catch-up contribution on top of that of $3,500. So $19,500 could go in on the employee side, plus a company match. But let's assume, a small business owner that you are, that it's a very small business, that you don't have you have very few employees or maybe no employees. There are some good options there for you too. We're going to talk briefly here about a solo 401k and a SEP IRA. They are similar but different at the same time. You can set these up. This is very common for our clients who are real estate agents, for instance. That's an example, but they're 1099, but they're self-employed, general contractor. They need a way to build some retirement savings because their employer side is not really going to – they are the employer side, right? They're not working directly for a company because they're not a W-2 employee. The easiest of the two to set up is a SEP IRA. You can put up to 25% of the employee compensation in on an annual basis. It is important to know here that the entire contribution is an employer contribution. It maxes at 25% of employee compensation or $69,000, whichever caps out first there. The key here is you don't want to have any other employees, or you want to have few employees, because whatever you do for you as a business owner, you have to do for the other workers in the business. And then on the solo 401k side, you can likely get a little bit more money in there. Those limits are the same as a company 401k or a corporate 401k. You can put $23,000 in on an annual basis on the employee side with a $7,500 catch-up contribution if you're 50 or over. The total cannot exceed $69,000 on both sides, on the employer and the employee side. So that's something to think about too. If you're Rachel, or if you're another small business owner watching or listening today. But one final one, Tim, that we can touch on briefly is the defined benefit plan, which also helps people who are high earners.
Yeah, this is almost setting up a pension for yourself, but you're really able to, if you are a high earner and you want to be able to take a lot of that and kind of defer it and not have to pay taxes on it in that year, we can actually set up a defined benefit plan that will have more of a pension look and feel to it, and be able to set that up for someone, and also be able to defer income taxes on that, which is something we all want to do. Yeah,
you could put up to 100% of your compensation. It's an average of the 3 past years, or $275,000 generally is the cap on that defined benefit plan. Helps you on the tax side too. This is very helpful for like doctors and people who are highly compensated. But again, back to Rachel's question, will it be enough on its own? The only way to answer that, Rachel, is to go through all those steps that we talked about and come to the conclusion of what's your asset level going to be, and what does that translate, how does that translate into income, and at what age. So we would encourage you to step into the planning process. And if you're a small business owner, we help people like you all the time transition away from work. So if you want to go through the GenWealth Ready to Retire process, we'd invite you to reach out to us. 866-653-PLAN. That's 866-653-7526. Next up, it's Lee from Pine Bluff. I plan to retire in 16 months. I will come out with around $225,000 before tax. Can I prevent my money getting taxed again as added income? Lee, thanks for the question. I think we've got some questions for Lee to start with, because here's what's unclear in the question, Lee. When you say you will come out with around $225,000 before tax, we're going to need to know, where is that coming from? Is it your 401k? Is it a pre-tax contributed to plan that you're talking about here when you say come out with $225,000? If that's the case, though, Tim, he says keep his money from being taxed again, it wouldn't have actually been taxed in the first place yet.
Right, because when you are contributing from your paycheck, that is pre-tax, and so you were able to keep taxes off of that. It has now, assuming that it isn't a 401k or some type of employer plan, it has grown tax-free up until this point. And it only becomes taxable when you actually start withdrawing that money from the plan or from an IRA if you roll that over, and there's some other options that we can go through on that. But the only time you're taxed on that, and it will only be taxed one time, is when it is actually withdrawn. Also, depending on how much income you're taking out on an annual basis, some people, if they're just getting Social Security and peeling off some of that withdrawal from an IRA or a 401k, can actually remain in a very low 0%, 10%, 12% tax bracket. So the income taxes on that can be very limited, and we can help structure those withdrawals to make sure that the income taxes are very limited. So that's really from the standpoint of if it is in an employer plan that can be withdrawn over time, that's probably the scenario. But again, if it is something where it's a deferred income that we haven't had taxes on, and we don't have really a choice to stretch out those withdrawals, and it has to be taken out in a lump sum. And sometimes we actually have people that come in and want to pay their mortgages off and take a big lump sum out, not thinking that that's going to actually put them in a much higher tax bracket and really probably have a negative effect on how much their income can be stretched out over their career of retirement. And so there's a lot of different things that come into play here. We definitely need to make sure we have all of our questions answered. And Scott, I think sometimes we probably end up with more questions than answers on this show because of the questions and how they're asked. But it's definitely something that we can help with.
Well, and here's the thing that Lee needs to know, and everyone listening needs to know. If you have not paid taxes on your retirement contributions into an employer-sponsored plan, when that money comes out, it is going to be taxed. And there's absolutely no way to avoid taxation. So if you're hearing out there otherwise, don't fall for the trap that you can avoid taxes. You can make a plan to minimize taxes. And Tim has already talked about how to do that. Keeping your taxes low means keeping your income low, because obviously we have a tiered federal tax system in this country. So if you're not going to actually live on a whole lot in retirement, you can certainly minimize, if not reduce, the taxation on those withdrawals. But if it has not been taxed yet, it is going to be taxed at some point in the future. And if you delay those withdrawals, at some point you're going to have to take that money out if you live long enough. And if you don't, it's going to be passed on to the next generation, and they're going to have to be taxed. So it's got to be taxed. It's just about making a plan to minimize it. And you can move that money without taxation. So we should mention the 4 options you have. If you're leaving that employer and you have that money in your 401k, you can leave it there. We can also roll it to an IRA, and that rollover is not taxable. You can, if you do get another job and there's another employer plan, you could roll it into the new plan. But if you're planning to retire, that's not likely an option for you. And the 4th option is to cash it out. Take it all out at once, and you don't want to do that for the reasons that Tim's already mentioned. So that's if it's in an employer plan. But I can't help think the way the question has been phrased, how can I prevent my money getting taxed again as added income? There might be a possibility here that Lee has his money somewhere else. It's not in a 401k.
That's possible too. And the thing that if it is in your savings account, obviously you're making interest and you're paying taxes on the interest that you have. But if it's invested and you're seeing some mutual funds or some stocks go up in value, you still pay taxes, but it's on capital gains. It's on the increase and above and beyond the money that you invested, which you've already paid taxes on. So, you're paying taxes again, but you're actually paying taxes on earnings on top of that. So you're not normally going to have double taxation on withdrawals from any of your accounts. I mean, corporations do the way they are set up, but individuals, we definitely pay our fair share of taxes, but it's not normally taxed. We're not taxed on the same money twice.
So, Lee, I would just encourage you to reach out to a GenWealth financial advisor, get your questions answered. That can be a phone call. You don't have to come into the office since you're in Pine Bluff. I know we don't have an office in Pine Bluff, but you can call 866-653-PLAN, 866-653-7526, and just have a discussion with one of the advisors here so we can get some more information so that we can more accurately answer your question. But in the meantime, we're going to say congratulations to you. This is the question of the week, Lee, and we'd love to send you a free Get Ready for the Future Show tumbler for being the question of the week. To claim it, just send an email to show@getreadyforthefuture.com. All right, our next question is from Patrick in Conway. How can I better understand my risk tolerance? I sometimes struggle with the fear of losing money while also experiencing fear of losing opportunities. For context, I'm 53 with about $275,000 in the market, $100,000 in other investments, and about $60,000 in savings. Patrick, thanks for the question. Thanks for the context. But whether you're 53, 23, 83, we can tell you that you're not alone when it comes to having this fear. Because I tell you, we say this kind of jokingly with our clients when we're first meeting them. That is what every client wants. We don't want to lose money. We want to make money. And the third thing is sometimes they say, and I don't want to pay for it, right?
Exactly.
So there is this this potential problem when you try to take on risk. But the first thing you have to understand is when it comes to reward, this is a risk versus reward industry. There's no question about it. To get more reward, you have to take more risk. And if you lower your risk, your reward is likely to go down. Now, it's hard to really see that in today's interest rate environment because you can be rewarded pretty handsomely compared to where we've been over the last 20 years in terms of parking your money in safe instruments like money market accounts and CDs and get about 5% on your money. So it's not a bad thing to have some of it over there. But over the long term, I think when we start answering Patrick's question, the real risk is not achieving your retirement goals. So when you think about analyzing your risk tolerance, think about it less in terms of how much risk can you tolerate on the investment side, and really think through what are your retirement goals and what type of risk do you need to take on to achieve those retirement goals. You don't need to better understand risk tolerance. You need to better understand your retirement plan.
Yeah, you really need to know where you're going. It's kind of like Wayne Gretzky always said, you don't skate where the puck is, you skate to where it's going. And so we need to find out, where is Patrick going? What's his overall plan? And then we take the risk, the necessary risk, to make sure that we can achieve the outcome that we're looking to achieve. And so, a 53-year-old, we're getting close to the edge of that retirement red zone that we always talk about. It might be time to change some of the investments, but we need to align those according to a plan that we can develop. And so we're looking at probably another 30 to 40 years maximum or minimum as far as a timeline goes for his retirement to get him to maybe age 90 or so. And so we definitely need to have some growth mutual funds and different things in there that we can definitely keep up with inflation, because we've all felt the inflation over the last few years. We're hoping that that's going to be over a short period of time, maybe the next few years, be pulled back down and maybe more of a steady 2 to 3%. But we're kind of in line with what that average has been over the last 50 years as far as a 3% inflation. Hopefully we keep it lower than the 7 and 8 that we'd seen in the last couple of years. But we need to make sure that we're continuing to build our assets so we can keep up with inflation and continue to have the spending power in retirement to keep up with the price of milk and bread and other things that we're going to have to buy.
Yeah, here's the thing too, Patrick. If you're struggling with fear of losing money or fear of losing opportunity, something that can help take fear out of the equation is to build that plan. The plan is a reference tool. You go through the process to build it, and you know what you're investing for. You have to invest with a purpose. We have to know why we're doing what we're doing, and when you get it written down on paper, on purpose, you can go back and refer to it. You can track it. You can work with a financial advisor, see how you're doing on a year-to-year basis. It keeps the long-term perspective in mind, and it keeps your purpose in mind. And your purpose here, in most cases, now people invest for various goals, but in most cases it's retirement, and in most cases you're trying to replace a paycheck in retirement. You have to have your assets grow to the level that will make that happen. So you can't get growth that's needed by being too conservative, and you can't protect like you want by being too aggressive. So to Tim's point, diversification is the key. And I would point out too, just looking at your number on savings $60,000 is kind of a lot. If that's all in cash savings, we're assuming that's what you're telling us there. That's a lot. We wanted a good, robust emergency fund that can handle anything that's going to come your way. You can create that number, or you can set that number, I should say, in various ways. You can use the Dave Ramsey approach of 3 to 6 months of living expenses, or you can set a number that you feel comfortable with, but sometimes it can get to be too high and you have too much money parked on the sidelines. And unless there is a specific purpose for having that much in cash, like you got to remodel, you're going to buy a new car, then yeah, you probably do have to have that much in savings. $60,000, I think, Tim's a little high.
It's a little high, and so, but you want to be able to sleep at night, and a $60,000 makes someone feel better sleeping at night. That's fine, but somewhere in that $20,000 to $30,000 range for most of us would be a fairly comfortable level. And I think one of the things that if you're going alone with this investments, I mean, one of the things that really impacts the overall return of investments over a longer period of time is your behavior, and a lot of that is because we do get scared when the market starts going down, and we do the exact wrong thing at the wrong time, which is maybe jump out and move everything over to cash or move to a money market account. But then the market starts going back up, and we wait, and then we jump back in when it gets higher. And so we really dilute the overall returns by really, again, doing the wrong thing at the wrong time. Maybe it's a fear of missing out. You're seeing a stock or something shooting through the roof, and everyone's buying it and making money, and then the next thing that happens is you jump in, and then all of a sudden it goes the other direction. And we've seen that in Bitcoin and other things that just kind of fly from time to time. And so we really need to have someone that's on your side that's reminding you and reminding me, because I've done it in the past as well, that we need a long-term goal, consistent goal, and we need a long-term strategy for our investments. Something that's going to be able to, stomach the ups and downs. But again, it's staying invested, and it's staying where you need to be, whether it's growth or whether it's maybe a more moderate strategy, or even having some in cash. Because right now, like Scott said, we're getting 5% on CDs and money market accounts and things like that, interest rates that we haven't seen in a long time. But again, that may be temporary, and we may be seeing those go back down. And we have to keep up with our three big risks, which I talked earlier about inflation, but we don't know how long you're going to live in retirement. And we really don't know what the market's going to be doing when we go into retirement. We're going to have ups and downs, and we need to be able to have a strategy that we're really considering all three of those.
All right, time for our final question on today's show. It's from Karen in Greenbrier. Karen says, I'm 45 and want to retire in 10 years. We've got $450,000 in various retirement accounts already, and I plan to max out catch-up contributions when I can. My husband thinks we should work at least till we're 60, but I think that's mostly based on fear. How do we know if it's okay to retire early? First of all, Karen, great job so far. You are on solid footing. That sounds good. $450,000 with a 10-year time horizon. And it's a great idea to be maxing out those contributions and take advantage of the catch-up contributions when you get to 50. To truly know when it's okay to retire, you have to be able to translate where your assets are going to be at your retirement date and know what kind of income that's going to provide. Will it replace your paycheck, or at least enough of your paycheck that you can meet your income needs and desires? And the only way to know that is to plan. The Ready to Retire process here at GenWealth illustrates what that $450,000 at age 45 will grow to by age 60, your husband's projected retirement date. And then it will show you how much monthly income you could potentially receive through retirement when incorporating all of your income sources. We need to know about Social Security. We need to know about pension, plus investments, and then work backwards to see then from there if it's okay to retire earlier than age 60. So I would say the planning process here, Tim, tells us to go, let's see what 60 looks like based on the trajectory you're on, and then see if it makes sense to retire earlier.
Yeah, it's a great goal to retire early, but there are a lot of different impacts that we have to consider, because if you retire much earlier than 60 and you've been putting all your money into retirement accounts, there are some limitations on how we can pull that money out and when we can pull that money out, because usually if you put it in an IRA or move it to an IRA, you can't pull that money out without a 10% penalty until age 59 and a half. Now, there are some rules that if you leave an employer and you leave that money in a 401k after the age of 55, then you can actually pull that money out without the penalty. But there are some other alternatives, but they're not all favorable in the long run. One of the other big impacts, a lot of people don't know if Social Security is going to be there. We do believe there's going to be something there, and especially us that are getting closer and closer to that day, we don't see any changes. But you being 45 right now, there might be some impacts on what Social Security looks like. And if you retire early, one of the big things, and don't want to get into too many of the details here, but your Social Security looks at your 35 highest average or years of working earnings history. And if you don't have 35 years of working history, that's definitely going to impact your Social Security when you get there. So you really have to be able to accumulate a lot of assets, and you're off to a great start at $450,000 at 45, and there's potentially a lot of growth on that. And as long as you're continuing to contribute, I think, as Scott mentioned, shooting for 60 right now. Maybe your husband is a little fearful in that, but he may tend to be on the right side here. But we, again, need to probably look at 60 and then see what's 59 look like, 58. What can we get to? And we don't know what the market's going to do between now and then. It could give us some great returns, or it could be kind of lackluster. So again, having that target to shoot for is the first thing that we would need to do, and to see what kind of assets we would need by age 60 to see if that could work. Yeah, and you're going to need to really consider your health care situation too. If you're going to retire before 60 or even 65, you're going to have an option for health care premiums, health insurance premiums, prior to being eligible for Medicare, which kicks in at age 65. And then past that, you have to think about how many assets you're probably going to need for health care costs, because Medicare is not going to cover everything. I read an article just this morning about the estimated cost that a couple is going to have in health care, and they said if you're currently on prescription drugs, that you could expect to spend out-of-pocket $300,000+ through the course of your lifetime from age 65 on. So healthcare has to be a key consideration. And then two, I would also work on, as a part of this plan, if we were putting it together for you, Karen, eliminating your debt, if there is debt, if there is a mortgage, to minimize what kind of income you would need prior to retirement. And oftentimes, whether it's retiring at 55 or 65, we want to make sure that you kind of have a plan for what you're going to do with your time. Yep. And so, working part-time may be something that's going to be something you enjoy, making quite a bit less than probably what you're doing today, can also fill the gap between what you're going to have to take from your investments and what you would like on a monthly basis for your income. Great questions today from Rachel, from Lee, from Patrick, and from Karen. We thank you for sending those in. And if you have questions for us, we'll tell you at the end of the show how to get them to us, because we want to answer them. But right now, you hear the bell in the background. It's time for final thoughts, and Tim, we'll start with you. Well, I think that we kind of go back to almost every question we ever get. It seems like, it goes back to we need a plan. And that's something that we love to put together for our clients and to work out for our clients. And we can ask all the questions and get the answers from you on what you would like to do. But one of the great things I think right now is what we're being able to do is getting back into the workshops and being able to get out and put those on, provide free education to anyone that wants to come to those, and have a free dinner. But just meeting with our clients, meeting with prospects that would come to those, and be able to provide that education for them. So that leads me right into mine. There you go. That's what you were trying to do, wasn't it? Absolutely. Man, you're setting me up. Trying to get better. All right, so those two events that are coming up, couple opportunities for you to join us at an in-person GenWealth Academy workshop. We've got 3 keys to retirement income planning. That's coming up very soon, so you're going to need to sign up because space is limited. May 7th at 6:30 at the Chenal event venue in Little Rock. We've been talking a lot about retirement income planning on today's show. It's what we do every day here at GenWealth Financial Advisors, and we've got 3 keys to consider when it comes to retirement income planning. If you're close to retirement, 5-10 years away, you're going to want to be a part of this workshop. And again, we're not there to sell you anything. It's all education-based. And then the other opportunity to join us is how to maximize your Social Security. That's coming up May 14th at 6:30 at the El Dorado Conference Center. Social Security is such a big part
of your retirement income planning. So making the right decisions on how to claim your benefit, when to claim your benefit, especially if there's if two of you involved, if there's spouses that have to claim. That's a great opportunity to learn more about that. You can visit getreadyforthefuture.com/academy to learn more. And that is all the time we have for this week's show. A reminder, if you want to get a question to us, the number to call or text is 501-381-5228. You can also send us an email, show@getreadyforthefuture.com. See you next week.
The GenWealth Financial Team is available to you 24/7 at info@getreadyforthefuture.com or call our offices at 866-653-PLAN. That's 866-653-7526. You should personally consult a financial advisor before making any investment, and no strategy can assure success. Securities offered through LPL Financial, member FINRA SIPC. Investment advice offered through Independent Advisor Alliance. Independent Advisor Alliance and GenWealth Financial Advisors are separate entities from LPL Financial.